All right, markets continue their decline over the past few days with the weakness. Of course, the big news after hours is a humongous jump up in NVIDIA. So that's going to impact a little bit of what we're seeing in the closing charts. But interestingly enough, it really only impacts the S&P and especially the NASDAQ, where it has much bigger weightings. Something that came out after hours that may offset that's the credit watch announcement from Fitch on the U.S. debt. So that's also a factor that appears to be impacting the Dow and the Russell more than the S&P and the NASDAQ that have been influenced by NVIDIA. So we're setting up for kind of a battle tomorrow between two different sentiments. We'll see which one's the winner. We'll talk about going into the overnight session, the technical environment that we're seeing and what we might get out of, especially considering some of the sector rotation moves and the especially over the last few days, the different asset class movements. They're very, very telling. So I'm going to talk about what they're telling us. And then our trade idea is a stock that we've traded again in the past, very similar to our last video, that we'll look to make another trade with today based on its current pattern. So let's go ahead and get started. Today is Wednesday, May the 24th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video that we do at 3:30 Eastern time. Come down to the bottom, click this heart. It opens up this tab, which is your Twitter account. Click that like button there. Same thing here. Click on that thumbs up icon on the Facebook image that will eventually come up here. There we go. And you click on that thumbs up icon. It takes you to this tab. Hit that like button there. Big time move up to over 100 again. We've been a few videos since we've been over 100, so thank you very much. That's our goal every time, so I appreciate that. Those who like us, thank you. It's a big deal. That's how we get our content out to everybody. For those who don't, you can do right now with one or two really easy clicks while you're watching. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see on the chart here, we got our second bull tag. We got the first one back here at the beginning of the month, May 4th, and you can see how we finished the rest of that week. We actually finished really well the rest of that week. The time before that was actually the very end of April. We didn't quite get a bull tag because the intermediate line wasn't below 80th percentile yet, so we weren't light pink shading because that's what you need, light pink and the yellow line when you cross. We just had the yellow line. But we had a similar result, so we bounced there, we bounced here. Both of these had the momentum and the near-term lines down. Over here, we had almost a bull tag. We had the light pink shading. We didn't have the yellow line because the moving average was falling there. It turned back up after just one day, but it was falling, and that's why it was red. Otherwise, you would have had a bull tag again right there. And you can see we rallied. The near-term line did not get to the reversal zone. On that one, didn't get on the reversal zone here either. This is the fifth time the momentum line has dipped to extreme lows, and the third time that the near-term line has followed it down to pretty low levels. It's really bearish. The near-term line, when you're bullish, the near-term line just doesn't drop this low. It usually drops maybe a little toe dip below, but it usually doesn't drop this low. And we bounce back up the last few times. The question is whether we will this time. Intermediate line's falling. It's close to its market sentiment line. So we'll see if that breaks through or not. Of course, the big news in the after hours, the NVIDIA earnings. The stock is currently up 20% last I've seen, 20% there. The Qs are up 1.5% in the after hours. So the S&P will follow suit because NVIDIA is now a top 5 company in the S&P in terms of market cap. Heavily weighted, so the S&P will follow suit. The question, of course, is whether or not NVIDIA will maintain that rally after such a large. It's not very common for mega cap names to spike up 20% in the after-hour session. So it's something to watch into tomorrow morning's pre-market moves. And to how it opens up once volume kicks in, right? You'll have a surge in volume kicking in. either to chase that run up to the upside or to sell that move. And the question is, who's going to outweigh each other once the market opens? And that will be a really telling in terms of whether or not, if there's a stalemate, then you're really open up to the exhaustion gap, right? So we'll kind of watch that. Of course, that will impact the S&P. It won't impact the Dow. It won't impact the Russell, just kind of indirect effects, but not directly because they're not listed. NVIDIA is not listed in either one of those indexes. So as of right now, like this bull tag, again, can lead to a bounce, considering we've been bullish for a while. You know, we're not looking for a new intermediate run to start. The new intermediate run starts with the bear tags, right? So you're looking for either a bounce like the last one, or as was mentioned when we had this one, the 5 previous bear tags that we had gotten here when we've been in this bearish trend. So this would be 1, 2, 3, 4, if you count all of that as 1, and then 5. All of these have all started the bearish intermediate moves, with only the one here at the beginning of the month being a bounce signal. And so typically when you're in bullish trends, as we were here for most of the coming off the election low point, pre-election low point, all the way through until the fall of 2021, every bull tag was just a bounce trade as you were running on a bullish trend. And we are in a bullish trend right now, though it seems to be fading a little bit as we're converging. Intermediate line rolling down is some very bearish short-term sentiment. You can see over here during this entire bullish run, if I zoom in, you can see the near-term line rarely got deeply oversold, not until the very end, right, where it got deeply oversold, and that ended the run. So the fact that the near-term line has gotten pretty deeply oversold multiple times, again, suggests, you know, a little difference here in this bullish trend than the last one, which is why, you know, I would expect, again, barring how big of an impact and how lasting of an impact this NVIDIA move has on the market, barring that, you would expect that this would actually be the beginning of a new bearish trend. Maybe not tomorrow, right? And it doesn't really start until you break that 2.5% mark. You got to get below 2.5% or only 0.5% below. But that's definitely something to keep an eye on, because you keep in mind your Dow Jones Industrial Average, which again does not have NVIDIA in it. It's already, the bull tags have already played out to dark pink shading and a red line. So again, we have that dark pink shading and a red line, very bearish short-term sentiment, with the intermediate line well below its market sentiment, and already in bearish territory and pretty close to being in the lower reversal zone. So the Dow is already starting its intermediate decline that the S&P has not yet. Of course, the NASDAQ is going to be even more bullish than the S&P tomorrow at the open. It's up, again, like I said, 1.5% so far, it looks like, in the after hours. So its short-term sentiment didn't look very good either. Its intermediate line still strongly bullish, and you're way up here. You're looking at QQQ. This is trading. QQQ is trading at 374 in the after hours. I mean, that's well up above. If I read that right, maybe I didn't read that right, but that's well up above where we're at right now. So you're going to get a tremendous gap to the upside. Well, you can see right here. Well, it's trading at, maybe it was 337. NVIDIA is at 374. So it's at 337, and now it's at 336, which, you know, again, is going to be near these highs when we gap up to the upside. So you're going to get a pretty strong move. The question is, again, whether or not the market continues higher from once the volume kicks in. IWM, which also does not have NVIDIA in it, is also close to giving us that same bear tag signal. You got the light pink shading, you got the yellow line. I don't know why it's not showing, the bull tag's not showing there, but it's the same idea. The intermediate line, you were above it, you just crossed below it. Oh, we didn't get below it, that's why. You're only, you're still 0.2% above it. You're on the yellow line because the intermediate line is actually falling right now. So if we did cross below it, it would actually turn red. You are above a falling moving average, which makes it yellow. So that's why you don't have the bull tag, but it's the same idea, same concept. You got light pink shading in the yellow line, and depending upon how much we get below it in the after hours will remain to be seen. You can see it's not moving at all in the after hours, like the Qs are. So big difference here, and the same thing really when you look at diamonds in the after hours. It's actually down in the after hours a little bit. It's, you know, it's not moving very much. again, like the Qs are. So big difference. And even SPY, like I said, it is the 5th biggest company. SPY is up a couple of bucks here, up to 413. So it's essentially filling in this gap, almost filling in most of the gap there from this morning. So we'll see, how much, that's a common gap fill. And now the question is if it will be big enough by the time we open to not be a common gap in the bullish direction by the time we open up tomorrow. Let's take a look at some of these other charts now as we go through our routine here. You can see we got a transition candle developing. So you can see again weakness. We had a great breakout, and then just like that, again, as of right now, we'll see by the end of the week. The last time we had a bull tag on Wednesday, we just rallied hard on Thursday and Friday. So that's still a possibility, and which would be a very good sign for the markets, because we are right there at these resistance levels. I didn't bring this up before, but we are right here. So here's the regular candle. So you see how we've gotten back below after flirting with that 23% line on a closing basis, this time on an intraday basis back here in February. You can see we closed so far right back below, and we're flirting with closing below the 10-week moving average. So now we're back up. We're back up to around that 413 level. So we're not quite above that green and yellow line, but we could. And if we did, that would give us more of a bullish candle, a higher close. As of right now, it's a lower close, which with the upper and lower shadows would suggest a transition from what has so far been bullish to bearish. We had the transitions there, and we just ended up closing above that body, and we have to close above this body now to continue the bullishness. The other side of the spectrum, the Dow Jones Industrial Average, has given us the red arrow already. A couple weeks ago, it got the red arrow. You already had the transition. Unlike the S&P, which continued higher, the Dow did not. It's been getting lower closes, lower lows. The candle's not very big. The bearish candle's not very big, so we're still, okay from that perspective. If it starts to get bigger, then you start worrying about, the potential of that bearish intermediate run starting. But that's how the Dow is looking. The Russell, of course, has still been in transition mode and kind of a weak bullish candle, very weak bullish candle, and no green arrow on the moving average, on that 10-week moving average. And again, the size of the bodies, is you can see here, for a bullish move is very, very small compared to these other bullish moves that we had there. Let's take a look at the 3 green arrow chart. We now have 3 red arrows on the S&P 500. We also have 3 red arrows in the Dow, again, with a red line. See, these are yellow. We actually have a red line on the Dow. We have 3 green arrows still. We were close, but not quite, on IWM to getting a red arrow. The stochastics is close to getting a red arrow. So you're probably not going to have, barring a big move up in the Russell tomorrow, you're probably going to have at least 1 or 2 red arrows tomorrow. But you're still 3 green. Of course, the NASDAQ continues, and it again will be, because you're at 336. You'll continue to have 336 being right about here. You'll continue to have 3 greens tomorrow. So the NASDAQ is still doing its own thing. The question is, the last time we got 3 red arrows on May the 4th, we bounced up pretty nicely. 3 red arrows, really good buy signal when you're on bullish trends. But like I said, 3 red arrows, like the bull tag on the market forecast chart, can also start intermediate declines. Just like 3 green arrows can start the bullish runs, right? 3 green arrows can start the bullish intermediate moves higher. Let's take a look at the 2-line version of this chart, and you see how the S&P here has broken below its 30-day moving average. Still sitting at that point of control, so that's okay. MACD is, like I said, a red arrow, but slightly, they're both the MACD and the stochastic are barely broken below their moving averages. The diamonds, remember, is more bearish. You can see it's actually flirting with its 200-day moving average. So it's well below the 17. The MACD is negative and falling below its moving average. It's negative. Stochastics in bearish territory. This is the bearish pattern for the Dow. And it's relatively bearish for the Russell 2000 too, as you came off of the 200-day moving average on an intraday basis yesterday with that long upper shadow, and then now we're flirting with getting back below the 17, and the MACD rolling over and stochastic's flirting with breaking below its moving average here. Let's take a look at some of these other oscillators. The DMI is turned, I mean, look at that big bounce in the negative indicator. So your ADX is dropping as both lines are converging on each other. The Dow has already converged and flipped. So the Dow is flipped in the other direction. So you converge there and you flipped. Actually over here, you converged and then you flip sides. So we've been bearish. The ADX is rising. That's how strongly bearish the Dow is right now. Looking at the RSI and the CCI, you're below 50 and below 0 on the RSI and the CCI. You're in bearish territory, but you need to confirm it, kind of like the Dow has done. If you look at the Dow, we did drop below 40 today, and we have dropped below minus 150 easily. So the Dow has flipped to bearish territory, has broken below recent lows and 33,000, and is confirming that weakness on these indicators with their move into bearish levels. So you can see the weakness here. The S&P is broken below the midpoint of its chart. It's broken below its moving average there. The Dow had already done that. The Dow actually got a new 4-week low point today. So it's well below that line. Of course, the NASDAQ is still very strong. It had pulled back below its moving average. Obviously, we'll see how it winds up here tomorrow once the market opens and see what it does afterwards. Your whole, it's an interesting pattern here. It's a pretty decent sized bearish candle for the S&P. Bigger, it's one of the bigger ones. We had a pretty decent one on May the 4th. The last time we had 3 red arrows, the bull tag. We bounced right off of that. So we'll see if that ends up being the case here. We flipped the parabolic SAR up on May 4th. We did not do that yet. The hole was red on May 4th. It's not red yet. You expected it will be. Your diamonds, it is red, has been. The parabolic SARS has already flipped up, and this is a pretty decently sized bearish candle. The Qs actually had a pretty decent bearish candle too. In fact, the Qs, the size of the bearishness on today's candle is actually bigger than these other ones, these last times that we had the 3 red arrows. And you can see we did flip the parabolic SAR up today on the Qs. So a little bit, the MACD breaking below its moving average. So there are some bearish signs on that chart for the Qs. Let's look at the Bollinger Bands. The S&P had broken up above the upper band here just recently. Just like that, we're in the lower half of the chart, the bandwidth, not quite in the lower quartile. The bandwidth is still very, very narrow inside of the bandwidth. Your diamonds, however, we actually did break below, or got down. We were flirting with breaking below the lower band. We got to the 5th percentile, so we are easily in the lowest quartile for the Dow Jones. We are below the point of control, and you can see the bandwidth is set to break out of its Keltner channels. So things are deteriorating pretty rapidly for the diamonds. You can see the S&P has got a negative rate of change now over 26 days. Again, we'll see what happens tomorrow. We're below the blue line, above the cloud. We don't really have a trend going here. The Qs still have their strong trend going, not quite super strong. It's not above 80, above 5, but again, relative to everything else, it's intermediate trend strength, which feels super strong right now because your diamonds are below its cloud. You have a negative rate, a pretty strong negative rate of change, and the green line's actually below the blue line, and they're both falling. So the diamonds are showing a lot of weakness, and it hasn't even started a bearish trend yet. So the diamonds may just be starting and may be kind of telling us what to expect of the markets outside of these crazy AI moves that are going on these individual names, whereas the rest of the market just is not looking very healthy at all. Let's look at the intraday moves today. Your S&P did break it, like I said, into the lower half of the range. Closed below yesterday's low. Did not close below last week's low. The diamonds did close below last week's low. You notice the diamonds did drop today below last week's. Actually got a new 4-week low point. So your diamonds formed this bearish pattern here with the spike up, and off of a really, really low channel width that you would expect would start to make a run back up to higher levels. Your S&P, remember, actually spiked, got a 4-week high point, new 4-week high point here recently, and has since been moving lower. And we'll see if we get a new 4-week high point tomorrow, and see how much longer we need to wait for the red line to hit zero. Its channel width is really low, and so we're really setting up for some kind of breakout type move of a very, very narrow range on the S&P 500 in a very short amount of time. By the end of the day, the VIX looked better. It was pretty bearish early. I did finish above 20 by the end of the day today. But if you notice here, breaking above 20, barely breaking above 20. Last time it didn't get you here in May 4th. We did not get above 90% relative to VXV. This time we did. So a little bit more bearish this go around than that May 4th day. Remember, May 4th was the other date. We had 3 red arrows and a bull tag, and we just bounced off of that right to Thursday and Friday. Very strong moves and a great move into the close. You can see the VIX and the VVIX here are, here, let me put on the VVIX comparison so we can see that chart in comparison here. So the VVIX, you notice here, it's off of its highs, but I drew this line where it was earlier today. It was actually pretty darn close to where the VVIX was in October as well as in June. But you notice the VIX now is nowhere near where it was in October or June. So I think we really, remember, there's been so negative. There's been such a negative correlation. And that started this move higher on volatility that we were set up for with the banking crisis. It also started this move higher into those October highs on the VIX, the October lows in the S&P, where we were so the VVIX was ramping up while the VIX continued to move lower, and we had such a drop there and a negative correlation. So we've seen this multiple times now, where the VVIX ramps up while the VIX continues to fall, and that's led to a rise. Basically the VIX has continued to rise all these other times, and the VVIX rise, and the VIX has eventually followed. And I expect that will be the case again today. The VIX, again, at the highs of the day, were above its 50-day average value. If you take a look at it now here. There we go. So we did finish the day above the 50-day moving average. The MACD is, on May 4th, we didn't. We were just barely at the 50-day moving average. The MACD wasn't positive at all. Now we are above the 50-day average, above 20, the same level. The MACD is now strongly positive. So there's some more momentum here than what we saw before, and there's some opportunity for us for volatility to continue to rise. That's why I expect more, aside from what we just saw in the after hours. I think it's going to be a very temporary bump. I don't think it's going to be enough to bring like the Dow up with it, considering it's not listed on the Dow. And if everything else continues to falter, then expect this move on NVIDIA to be very, very short-lived, and to be a candidate for filling in its gap, whatever gap it ends up having by the morning. If you look at recent history for the size of gaps that NVIDIA ends up getting here, so it did end up with a 13% gap there on its February 22nd earnings, and closed with a 14% gain. So it didn't really move up any more than what it did in the after hours. This would be a 20% gap, again, depending upon where it's at right now. Last I saw was a 20% gap, so it'd be way bigger than what we saw in February. And again, what kind of move will it have afterwards? It'd be the biggest gap of the last 5 years if we end up with a 20% gap. 25% gap right now. The last I'm checking here is up 76 points at 382. A 25% gap. Again, that would be double the biggest gap that we saw in the last 5 years, which happened to be the last quarterly earnings announcement. So, and that one didn't extend with a big strong move afterwards. A little bit of an extra return afterwards, and some gains, but you look at all the red bars that came after that. So this is what it looks like here, the February 2nd move. Remember, this gap higher right now, if the market opened up right now, this gap would be twice as big as what we saw on right there. And again, the market didn't continue. It's actually started filling a little bit of that gap. We kind of converged for a little bit before it finally broke out and started to price in today's results. And like I said, it's going to be way higher, 382 right now, so way up above. It's going to be. We're talking. I can't see it. You can't. Right about up here is where it's going to end up being. That's a big move. And if that can't hold, if it starts to fill in, and however long it takes, 1 day or 3 days or whatever, then that will have a detrimental impact and kind of build on the weakness that we're seeing with the Dow, right, and the Russell. Not as much with the Russell, but especially the Dow Jones. Right now, let's transition and take a look at what's driving this action. Again, it's the Qs world, and we're all just living in it, right? Gold's up 7%. The Qs are up 11%. Everything else is either down or slightly up over the last 3 months. And if you look at just today alone, so let's take a look at today here, May 24th. You can see the dollar has been bullish, and that's putting pressure on everything. Real estate down the most. Developed markets have been down. You remember the Dow, the Russell. Here, move this over here. The Dow Jones Industrial Average has been bearish for a few days now. So if I were to go, and really the S&P for the last 4 days has been down to get to this bull tag, coming off of that really strong move on the 18th, so starting on the 19th going forward. So if I were to take a look at that time frame, you can see again the dollar is the biggest mover. Gold is up. Commodities are up even with the strength in the dollar. IWM was up, but now is down 1%. The Qs are down 1.65. Developed markets down 2%. This is all the weakness that we've had to get to this bull tag, essentially off of the peak on the S&P. That you can even see bonds are down, which means bond yields are rising. We're getting back to that relationship. Remember the relationship in 2022. The three-headed monster for the markets were a rising dollar, rising commodity prices, and rising yields. And that appears to be playing out again here over the past few days, as you've had strength in the dollar, strength in commodities, and strength in yields. So if you take a look at those charts separately, let's take a look at the dollar index, and you can see the strength in the dollar, finishing at the highs of the day, up 0.4%. The 8 and 17-day moving averages have crossed above the 30 and above the 50. We're filling in the gap between the 50 and the 200 with a MACD that's been rising. Not as high as it's been. It's been higher. There's been stronger moves in the dollar when it was in a bullish trend. We've been on this bearish trend below the 200-day moving average since it peaked late last year, and it's rising. That also means that the 10-year yield is rising. You can see getting back above 3.7% today. That's a pretty decent run off of these lows from just over a week ago, right around 3.4% or underneath 3.4%. So the MACD is rising, stochastics is rising. Here's what the long-term view looks like. You're getting above the 30-week moving average as the 8 and 17-day appear to be crossing with the MACD rolling up, stochastics rolling up. Here's what the dollar index looks like on a weekly chart. You're above the 17-week moving average, flirting with breaking above the 30, with the MACD and stochastics also turning up. So you can see we're starting to get some renewed strength in those areas. Commodities haven't been as strong. They're still subdued. Again, they're also impacted by economic growth expectations. If you take a look at the relative strength for commodities relative to equities, and let's take a look at, we'll look at commodities relative to, instead of the S&P, which has been influenced by these 7 names, let's look at commodities here relative to the diamonds, which only have a 9.5% weighting towards those 7 names. In particular, the Apple and Microsoft, the only 2 of the 7. So you can see commodities have been underperforming equities for quite a while. So we've been in this commodity funk after blowing up in 2021 and going parabolic in 2022. Again, that's the reason why the commodity, the inflation rose, and that's the reason why the markets were so bearish. You can see that Head and Shoulders peak there in October that kind of peaked with the lows in October for the equities market, and they started to bounce off of that as commodities have been falling. But you notice here lately, commodities has some positive momentum relative to equities, breaking up above their 17-day and 30-day moving average, or 30-day moving averages here. The CCI getting up to a higher level, the RSI trying to get back above 50 again. So there's been considerable weakness in commodities relative to these particular equities, and you wonder how much of that's going to be changing. Again, that had a very detrimental impact on equities in 2022. So is that three-headed monster roaring back again? That's the big question. When you take a look at all the other major markets that are out there, we'll go to we'll do the 12 grid first. You can see, look at Germany breaking down hard. Look at Europe all across the board are breaking down hard. China has broken down hard. Dark pink shading and a red line across the board, and like well below those moving averages. Japan has broken down to its moving average. Canada has broken well below its moving average. Brazil and Korea holding up. So there's some pockets of relative strength. India also holding up in emerging markets, but developed markets are getting hammered. And you wonder again, is that going to have an impact on U.S. equities? Are we going to just follow suit as at least I would expect that we would. Now let's take a look at how the sectors are moving, and we'll go here again. We'll go look at today's move. Here's the 3-month returns, and not surprising who the big winners are, but we'll look at just today alone. So let's go to May 24th, and you can see energy was a big winner, and some of these other cyclical names are your bigger losers: financials, materials, industrials, real estate really getting hammered there. And again, if you go back to the 19th, so we look at the last 4 sessions, energy is up. Even with the strength in the dollar, energy is up 2%. Utilities and communication services, healthcare outperforming the S&P, and then all these other cyclical financials, industrials, materials, all lagging. Very cyclical names. Even consumer staples is down here along with them. Anything consumer related, you see discretionary is down there too. So again, Nvidia is outside of that space in XLK, and will do its own thing. If you take a look at the 12 grid for the sectors, let's come up here to the 12 grid. Here's what's even more alarming about that. This is, you look how many oversold clusters we're getting. Again, the NASDAQ barely came off of a near overbought cluster. The materials, utilities, real estate, staples, healthcare, all 4 of the safety trades all got clusters. Materials, industrials came close. The intermediate line's only at the 45th percentile. And these are all dark pink shading in a red line. The only ones that aren't, of course, are your 3 up here at the top. Discretionary looking a little worse, barely below the 80th percentile. Financials are almost below the 50th percentile, to where they'll be dark pink shading in a red line. And then you saw energy here lately rising. But this is not normal. This is not normal for these to be going down while everything is going up. This is more indicative of, again, kind of a broader, weak economic growth expectations. And like I said, anything consumer being weaker. I mean, staples is down, is the furthest below this moving average. You do have real estate down 7% in the last 3 months, materials down 6%, financials down 10%, energy, even with the rally, is still down 5%. I mean, these are all pretty dramatic declines for a time where you have 13 and 14% gains in 3 months on technology and communication services. So again, it's this consumer economic growth space of the economy, economic growth sensitive areas of the markets, that aren't doing very well. And how much longer are these 3 areas that are not necessarily linked to consumers or economic growth expectations? How much longer are they going to be able to carry, and will they eventually be able to get these? Again, we saw that last November 2021, where there was such a discrepancy, and these 3 up here followed the rest to the downside by the beginning of 2022. And that's the pattern I expect will most likely be played out again. All right, let's take a look now at our trade idea of the day. So let me pull up this chart here, and we'll take a look. Another stock that we've traded here recently, and that is Delta Airlines. You can see Delta has been bullish, or bearish, excuse me. It's been relatively recently bullish, but not very strong. Obviously, it's clearly not moving in either direction right now. When you look at its long-term chart, the weekly chart, excuse me, you'll see that, and once it comes up here, you'll see that, you know, we had been bearish again because of these declines, but then it was just really just 2 weeks, and we've settled down, and the candles have gotten a lot smaller, and they're bullish. But if you look at the size of the bullish candle relative to where we are in the past, not very strong at all, and the PPO is very flat, not really trending in a direction either way. From a 3 green arrow standpoint, we're above the 30-day moving average. The MACD is green, the stochastics is green. You can see the MACD and stochastics are close to reds. So whatever bullishness, again, we've had since the 3 green arrow signal really was a one-day rally above the 50-day moving average. We've been coming back ever since then, right at the top of this valley area, working back towards the point of control. Obviously, slight bullish bias there. When you look at the directional movement index for Delta, you'll see that, again, both the positive and the negative indicators have dipped in there below 25, both below 25. Looking at the RSI and CCI, they're back in the middle of their charts in neutral range. The Ichimoku cloud is also neutral. We try to get above the cloud. We came right back into it. We have a negative rate of change again after being briefly positive. No trend at all right now down there at the bottom. And then finally looking at the Bollinger Bands and the Keltner channel here, you'll see that the bandwidth is still really small, relatively speaking, to its range, and a 52-week range and 150-day range. We're right smack dab in the middle, and you see all the red dots. The bands are still inside the Keltner channels. Look like they're about to get out of them and then turn right back in. So very neutral. That sets us up for a neutral trade. So you can see the trade we did was actually a iron condor spread here, where we sold the low 20 delta, sold the low 20 delta on this other side, went 2 strikes away on both sides for protection. That set us up for this risk profile, and then those strikes here are break-evens or outside of this range that we've been in for the last few expiration cycles. So of course, if you break out to either one of those, you're going to be moving in a directional move, at which point we don't want to be in a condor, and we'll be willing to take, you know, the $371 or less loss at that time, ideally avoiding the full $1,000 loss. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at marketscholars.com for free, as I showed you before, and follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.